Okay, good morning, everyone, and welcome to our second event of the week, our Coffee Microcaps Appendix 4C results wrap for today, Tuesday, the 1st of August. You're all very welcome. My name is Mark Tobin. I'm the founder of Coffee Microcaps for anybody who's joining us this morning for the first time. And for all our kind of regular attendees, welcome to this morning's event. I'm just going to quickly run through a couple of these intro slides, and then we're going to get straight into it with our first presenter. Firstly, I'd like to mention our new sponsor here for all our virtual events, ShareSite. It's a software that I use myself. And if you are looking for something to do portfolio tracking on your own investments, whether it's SMSF or your PA trading account, I'd highly recommend you check out their website. Quick compliance and disclaimer slide. And companies that we normally have presenting on here this morning is no different, generally capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources and biotech sectors, what I like to call industrial microcaps, which encompasses basically any other sector outside of resources and biotech. Structure this morning's webinar, we've got 4 companies going to be presenting over the next 2 hours. Each company will have a 30-minute slot, which we're going to break down into 20 minutes of a presentation, 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions to our presenters. And please be advised that this webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow. You can follow us pretty much on all the socials, Twitter, YouTube, as I say, for this recording, and indeed yesterday's event and all our previous events. We've got well over 100 company presentations on there now. LinkedIn, and I also write a free monthly newsletter, which you can get on this Substack platform. Up first this morning, we've got SenSen Networks, who are coming back. So Subhash, Challa, the CEO and Executive Chairman, is going to give us an update there. Then we've got another returning company, actually, Being Communications. Michael Capocchi is going to be joining us from Chicago. Then we have, we're going to go out west, Mark Waller, CEO of the recently listed One Click Group, is joining us from Perth. And then we're going back to the US for an update from Jennifer Warawa and Simon Yeandle from Quickfee. But that's enough from me. So I am going to stop sharing my screen. And Subhash, if you want to start sharing your screen, I'll let you know when I can see the slides coming up.
Is that share screen?
Yeah, it's coming through now. You just want to go to slideshow mode or full screen mode there, just so we get the full effect. Yeah, that looks perfect. Subhash, you can take it away.
Okay, thank you for the opportunity to present, and good morning to you all, and good evening if you're logging in from the US. So I'm Subhash Challa, and I'm the CEO of SenSen Networks Limited. Just want to give a very brief overview of what we are about. We're an AI company focused a lot on AI, dealing with cameras and sensors. And we belong to a space what we call as live awareness. So we take data from real-time sensor streams like camera, GPS, LiDAR, or radar. We also take data from real-time enterprise data sources like payments, digital maps, point of sale, rules and regulations that govern the context of a business. And when we combine those two in a systematic manner, you give an ability to be aware of the business. So we deliver this live awareness capability to governments, enterprises, and so on. And we have applications in roads, parking, airports, shops, casinos, and so on. So we call this live awareness, and it's a class of AI that uses cameras and sensors to constantly monitor business activity especially in the physical world, and interpret that activity within the context of business rules like digital information to improve operational efficiency and safety. The closest examples of live awareness are like a self-driving car. Okay, when a self-driving car stops because someone unexpectedly moves in front of it, it has used its live awareness capability to act and change a pre-programmed action because the AI is telling it to do something that has changed in the physical world. Similarly, when a robot or a drone delivers some or is on its path to deliver some goods and services without bumping into anyone, it's live awareness in action. But the above examples are basically where live awareness capabilities are very limited. They're using sensors and cameras to learn more about what's going on in their surroundings and the context in which to make the decision. But they're very focused and narrowly positioned to just drive a vehicle from point A to point B or move a robot from place to place. But the similar capabilities, if you apply in an enterprise context, let's say an airport or a casino or a parking context, then you still use cameras, LiDAR, and everything to interpret what's happening around you and contextualize the data. But you can then deliver more revenue, reduce cost, increase safety, and so on. You don't necessarily have to move a robot from place to place in this context, obviously. So we find that opportunity to provide significant efficiencies and safety benefits to enterprises is almost infinite. And we are one of the world leaders who recognize that opportunity and create a platform like SenSen, AI platform, which is our live awareness platform. Okay. So that's the context and where we fit in the big AI space, because so much is going on and people tend to ask, where do we belong? So to give an idea, because we have built this platform, we have this incredible ability to spin solutions rapidly based on the emerging requirements of the customers. So in just the last financial year, we released about 6 unique solutions that are solving something very important for different markets in which the solutions are operating. Going from left to right, we have Code the Curb with AI, powered by smartphone. Okay, this is a new capability to cost-effectively digitize the curbside or the footpath, as people sometimes refer to, and this is being referred to in the world as coding the curb or creating a digital twin of the curb. And there's a significant opportunity in the US and many everywhere else. We already are leaders in that space, but to do that with the smartphone and not using heavy equipment and deliver at scale changes everything for that market. Okay, and we are using smartphone cameras and smartphone GPS, and the integrated analysis of that is what delivers that. We have also recently introduced an AI co-pilot for mobile enforcement. So we are already world leaders in providing mobile enforcement to cities around the world, but there are a bunch of manual steps people have to do to make those systems work. We pretty much introduced a co-pilot where they can voice control everything. It kind of knows the vehicles with mobile enforcement system. They already know where they are and what they're meant to be doing without explicit instructions. And that again is a massive disruptor to the market. We also introduced recently a school zone parking enforcement solution where we needed to do green, solar powered, Wi-Fi enabled, self-managed kind of solution by sensing, danger for school kids when they're being dropped off. Again, around the schools to be aware of which vehicles are coming, where are the kids moving, and are they in danger? It's like live awareness in operation where we have been able to deliver that capability. And recently, we have also introduced some solutions for fuel theft recovery, which is another market where we serve our AI solutions, and curb enforcement in North America, where there was a need for doing real-time enforcement, and seaports, where, lashing and unlashing of containers has a lot of danger. So if you look at the breadth of solutions where sensors and cameras are being used, but they all follow similar pattern, where you got to extract information from those cameras and sensors, marry that with the contextual information of the business and take real-time decisions on what they need to do. And this is a new live awareness capability that we have. And as we move into the future, there are more and more things that customers are asking us to modify. So that's a space we are operating in, and gives you a bit of an idea. We had 6 patents granted in the last 6 months, 5 for casino gaming area and 1 for fuel retail space. Right? This video basically explains what
AI is all around us, creating images, generating text, as well as audio, video, code. Yet, there are many things AI cannot do. AI has no sense of its own context, no awareness of the physical world, of what things mean. And this is despite billions of digital sensors hooked up to computers and recording what the world looks like, how warm it is, how acidic, what it sounds like, how quickly objects are moving. Until SenSen, we give AI the context it lacks, a new sense called live awareness. Live awareness fuses any sensory input, whether streamed from servers, smartphones, or video cameras, microphones, accelerometers, GPS, or other connected devices. All of it is unified into a single consistent data layer, a layer revealing the most salient features of reality for the situation at hand, such as position, velocity, and proximity, or pressure, temperature, likely next direction, and luminosity. Whatever is required to give AI a complete sense of what's happening, to find important patterns, to trigger next actions, or ask a human being to make a judgment call. SenSen, the live awareness platform.
So that gives a bit of an overview of what kind of stuff we do, or what live awareness is all about. And we believe we are very uniquely positioned with huge track record of over 80 customers right now. Many of them are government, others are enterprises. And people ask, like, how do we actually make money? So this is the revenue model that we follow. It's fairly consistent across different verticals, showing there is a pattern for this live awareness AI and how you can monetize it. So on the left side, you see a select group of customers who have been there forever. And one of the interesting characteristics of this market also is that the churn is nearly zero. Okay? We haven't really lost a major customer in the last 15 years of operation. So we keep growing and the customers keep spending more money because there are new AI live awareness use cases they keep coming up with. If you look at the revenue sources, we have a software license revenue, which is recurrent, makes up about 60% of the revenue from a customer. Hardware sales usually are embedded into the initial upfront contract we get, which usually makes up 20%, and the professional services like technology trials or installation and configuration services, training or UAT make up another 20. That pattern is fairly consistent, some low, some high, but generally that is the model. Now going to the financial highlights of how we are tracking. First time ever in our history, we crossed $10 million in cash receipts. We actually collected 11.2 million in the financial year for the first time. The previous high was 8.8 million, which happened last financial year. The last quarter, we collected 3.3 million, slightly less than the previous corresponding quarter, but in the same order. And we expect, records to be broken as we go into the future. We pretty much delivered 27% year-on-year growth in customer cash receipts against the backdrop of extremely turbulent economic conditions. Prior to this, when the economy was more favorable, we grew 50% or more. So we expect to keep, breaking those records of growth as we move forward. This also demonstrates the resilience of the business with a balanced mix of government and private enterprises. Governments are often slow, but very, very sticky. Even our private enterprise customers are very sticky. They're a bit faster than the government. But if you look at the graphs at the bottom, on the left side, we have cash receipts. You can see a continuous ongoing growth. that is there. The greens represent corresponding quarters from previous two quarters. And then on the right side, you have, how our OPEX is tracking. And you can see that the blue is getting very close to red, and we expect it to cross over in the next financial year. So it's a moving average over 12 months. So you can see that the general trend is smooth and getting towards that crossover point. Here is a couple of updates on specific markets. So in casino gaming market, we won a USD $1 million deal or deals in the quarter. This is despite some patent infringement cases and stuff like that are going on. We have our own patent portfolio that is growing strongly in this area. And we don't have any specific update for the specific patent dispute we have, but things are going as we expect. This is a quick corporate snapshot of the shareholding pattern of different people in the company. This is our board, which is constituted of myself as a CEO and Chief Operating Officer, David Smith. And we have one non-ex director, Zenon Preciously. I'm up for questions from the people.
Thanks, Subhash. I might just jump in with the first one. I know you guys are on a pretty big US expansion, and we were talking about it offline just before we started. Maybe just give us an update on the plans for that, and maybe a context of where the US business is at now relative in size to the Australian or Asia Pacific business. Might be more of a apt regional description.
Yeah, so US has always been the biggest market. In fact, in 2019 ending and beginning of 2020, I made my plans to go to US to accelerate growth there, because we already won Chicago and Las Vegas at the time, and it was an opportune time for me to go there to kind of further accelerate the business there. Unfortunately, COVID came and border shut down, so we all had to come back, and this was the second and the next opportunity I'm now taking up to go back, given the size of the market and the opportunities we are already getting. Okay, we have grown quite significantly in Canada, which was one of the first markets we got in North America. Then we went into US, but we grew like more than 10 cities last year, and it's all just getting started. There's a huge opportunity in curbside management. Security is much bigger in US than Australia or anywhere. We don't think about security here. There they talk about every day. Casinos in Las Vegas are big. So we already have Paris International Airport, which is Las Vegas Airport, as our customer with more than 3,000 cameras using our system. We are also already one city of Las Vegas. And we are in, deep discussions with many casinos to adopt our casino solutions. So I'm going to base myself in the US, in Las Vegas to begin with, and grow the market over there.
And in terms of, you had the slide there with, the long-standing customers. A lot of them are RCs, many of them based here in Australia. What is, the ability to still, upsell further products? You talked about the 6 releases that you've had this year. Within those long-standing customers, is there still scope to upsell them with like new products or new offerings, or, and how long does that take, given you're, an existing known supplier on the preferred supplier list? Does it still take, even though you're kind of a known entity, it still takes a long time for them to kind of grasp the opportunity of the new product set?
Yeah, so in fact, if you look at last financial year, majority of our revenue growth came from upsells. Okay, because of markets coming out of COVID and slowed down growth and all that stuff, right? So a lot of the revenue that came last year was from these upsells. The Canadian customers we got, we'll see the revenue coming more in this financial year because we're delivering that and all that. And our net retention rate of customers is, pretty close to 100%. It's always been above 100%, and which tells you we are not losing, but we are actually getting more money from the existing customers, even in metrics that we follow, right? So, yeah, I mean, the challenge for the company is really, that we keep getting more and more orders from the existing ones, which means all the sales people get busy with, getting more money from the existing ones. Okay? So we need to do the greenfielding, where we got to go and do the hunting part, where we got to get the bigger new customers to be added. So when economic, conditions are tough, we just focus a lot more on existing accounts and upselling, and because that's the fastest way to generate revenue. Now the growth is palpable everywhere in the world. We want to get our attention to new accounts as well. Yeah, it's a balanced strategy we have on how upselling is a way where account managers focus on upsells, and the sales talent focuses on farming, so or hunting, I guess.
And then can you just give us a context, if we talk about those Canadian customers, of, you sign a new city, say it's for curbside management or a new airport or a new casino, from that initial signing to, full implementation where you're now capturing the license fee, all the hardware's been deployed. I know it's hard to say on average, but just give a sense of those kind of timelines. So, if we see these contracts coming through, what people should be thinking about in terms of when the revenue and cash flows are actually going to materialize, 6, 12, 18 months out from the day of signing.
Yeah, I mean, in smaller accounts, it tends to be 3 to 6 months. Okay. But if it's a multi-million-dollar account with lots of things going on, it can be between 6 and 9 months. So it's that variation between, once the order is done, 3 to 6 months, if it is a well-proven product and it's no variations. But sometimes customers have, because it's all new, AI is all new and their requests are new, sometimes they change. And if we had to accommodate new capabilities, it can take between 6 and 9 months, right? So that as we are progressing, it's getting faster and more easier, but AI is going to keep exploding. So our strategy is simply, if our net retention rate or having our customers is a long-term ARR paying customers, it keeps making our company more and more valuable just with time, because we're getting more and more revenue and more accounts. So that's been our primary strategy, and now we are close to 80 plus customers. My next target within the next half year is to get to 100 customers. Okay. And one of the other very important points, I think it's often missed in analysis of our announcements, which makes it harder, is that the first contract we normally announce will sound like a very small contract. It'll sound like we got a 100K contract or 200K contract or 500K contract, something like that. Okay. But the lifetime value of each customer is multiple $1 million. Like if I go back to Brisbane City announcements, I might have made 2 announcements. One was for 350,000, another for 700,000 or 800,000. But they generate multiple millions every year, which is not an event in time, because it's a recurrent revenue and things come on top of each other. So when people analyze our company, it's almost like every time we win a customer, we pretty much won a future revenue of many millions of dollars with high margins. So we're trying to get that communication into coverage by our partners to kind of make people understand how attractive it is for SenSen to win customers and keep growing our baseline.
And maybe if we just expand a bit further on that point, typical contract lengths then, and highlight of a difference between the private sector and the government sector. Are they rolling 12 months, 3 year, 5 year, or potentially even longer, maybe in the public space?
So usually they start off with a POC. If it's a complete greenfield customer, they'll want to know if the technology works in their context. And usually 95% of our, even POC customers are paid customers, that we don't do free stuff. But then once we got going, my longest customer is like 15 years. And, and every customer after that is just adding and sitting in my account. Okay. So usually initially it will be like a 3-year contract or 5-year contract, depending on what they do. Typically governments do 3+1+1 kind of stuff. Then either they go retender or they kind of expand. And so far we have won all the retenders that was ever been released. And we've been, expanding further on whatever contracts that we have. So one example is Singapore. We won a road traffic contract for illegal parking enforcement on the streets back in 2014. And there are 3 retenders that happened, and we won all 3 retenders through different system integrators, okay, that were representing us. So the core of the technology and capabilities is unique and strong, and we keep updating with new AI technologies that are being released in the market. So we're always on the tail. That's why you see so many patents and other things coming up, because they're on the, always catching the tail of the next wave and making sure we are ahead of the competition. So yeah, my longest customers are, 10, 15 years old, and the latest ones are the ones we acquired last year. So, and they're all there, still growing with us.
When you mention system integrators, just on the hardware piece, is the hardware, any of it yours, or is it, your technology over a system integrator's hardware, or some, kind of standard piece of kit that's specified by the city itself that, they want to use something from Siemens or something from Samsung or whoever it might be?
Yeah, all hardware is commercially off the shelf. Means, anybody can go buy from a vendor, and they're all well-known vendors, right? So it's not like any specialist thing that, you're designing specially for something, okay? That's rule number 1. Rule number 2 is that all live awareness capabilities, like I want to be aware of what's happening on a casino table, requires a particular specification of hardware, what resolution, how high or tall the camera need to be, or where it need to be positioned. Sometimes like in a casino context, they'll have a requirement that it should be covert or not visible. And so when you go to different customers, they all have these different constraints, if you want, under which the live awareness need to happen or work. And we are experts in defining those variations, and we will spec the products to meet those constraints. Okay, but all the products can still be bought from a commercially off-the-shelf, suppliers. Okay, so hardware, we are completely hardware agnostic, but given a particular live awareness problem, an AI problem, we spec what that set is, and the SIs can buy it or we can supply it, and that varies, based on context and so on.
And I'm presuming, is it safe to say, just one final question when we're still on hardware, and you mentioned COVID disrupting your initial move to the US, supply chain logistics issues in terms of, getting specific pieces of kit, or integrators getting specific pieces of kit, is that still a factor in terms of project rollouts for contracts, or has that kind of COVID disruption and backlogs worked its way through the system? I know, China's only recently opened up, let's say February, March this year. Is it still a nagging problem, or has it kind of resolved itself over, let's say, the last 12 months?
Our core value proposition or USP is software. So we are not so dependent on the hardware, but because we are hardware agnostic and we have multiple options, we pretty much got around that problem of hardware delays and stuff like that. I think in general, post-COVID, people are all doing just-in-time inventory and not, piling up stuff, and they're because of other economic situations. So there's some natural lags in the system like that, but not anything COVID specific or not. And because we can do the same solution using multiple sensors and camera manufacturers, we're kind of de-risk that part anyway. So in case you get a block from one supplier or one particular technology zone, we can always go to another one, right? So that's not a major constraint right now for us.
Perfect. Subhash, that gets us right up on time perfectly. Thank you very much for coming back and giving us an update on all things SenSen, and best of luck on the move to Las Vegas, and hopefully we can get you back on and maybe a bit later in 2023 when you're settled and you can give us an update live on the ground from the US.
Thank you. Thanks a lot for the opportunity, and good luck for my next presenters.
Okay, no problem. Thanks, Subhash. And yeah, our next presenters are chomping at the bit here. I see we've got Michael and Dean from Beam Communications. I'm not sure which one is sharing the presentation, Michael or Dean. If you want to share your preso, I'll let you know.
Good morning, Mark.
Good morning.
Like me to share it now?
Yeah, you can share it now. I'll let you know when I can see it coming up. Yeah, it's coming through now. And yeah, if you just want to go to the slideshow. Yeah, perfect. There we go. Yeah, Michael, take it away. We'll tackle questions at the end.
Excellent. Good morning, Mark. Good morning, everybody. Thanks for taking the time to get an update from Beam Communications. I know a few of you joining today are Beam Communications shareholders, and I want to thank you for taking the time. And for those that are not shareholders, look forward to presenting to you and allowing an opportunity to learn a bit about Beam Communications. I'm Michael Capocchi, Managing Director of Beam Communications Holdings Limited, and with me is Dean Sleigh, who is our Chief Financial Officer. So we will go through this presentation together and give you a fairly good update on where things are at and the opportunities in the market and how our results are looking for the end of FY23 and beyond. Beam Communications has been around for over 20 years. We specialize in the development, design, sales, and manufacture of satellite communications equipment for personal, enterprise, and government applications across land, sea, and air. So our predominantly focused on the Iridium satellite network, but we also have been making product for Inmarsat and Thuraya. So 3 of the 4 main mobile satellite service companies. And we're very proud of where we are at this point in time, being a very well respected designer and manufacturer of this type of equipment. Just a quick recap on the company. So current market cap as of yesterday was $16.9 million. Dean will talk a little bit more about cash and how we've ended up with a position of around $5 million at the end of last quarter. An enterprise value, 11.9 million. Share price, 52-week range of 15 to 31 cents. And in our top 20, we're almost 60% of our shareholding. Total shares on issue is 86.4 million shares. Highlights for FY23, and we obviously did provide a confirmation of our profit guidance last week, and also obviously an update in the 4C just on Friday afternoon. So, we're very comfortable where the year will end, which is why we're happy to reinforce, obviously our position on our profit, also our cash. So ending the quarter with $5 million of cash. Our royalties from our subscription services continue to be strong, continued growth across the satellite market, and particularly growth both in our Zoleo business and our recurring revenues from the deal that we did with Telstra last year, contributing very well to our growth in subscription revenues. Our Zoleo subscribers for Australia and New Zealand closed at 6.2 thousand subscribers. And we did also announce the total global subscribers for Zoleo Inc. So the total business closed 30 June, just at over 71,000 subscribers. The Zoleo Inc. joint venture, which Beam owns 50% of, the FY23 revenues are forecast to be around $27 million, with 2/3 of that being the recurring subscription revenues. So obviously, where we've ended FY23, we're seeing quite positive trends into the current financial year and are quite optimistic about where we are heading in FY24.
Thank you, Michael. In terms of cash and cash flow, we made a number of statements to market in terms of the unwind of our trade working capital. So very pleasing to see that delivered for us in the last quarter of the year. So we closed the year in the order of 5 million cash in the bank. We have undrawn debt, just over $1 million, undrawn and no plans to use the debt in the near term. We have a strong balance sheet to be able to fund the CapEx profile and the business as we look into FY24. Interesting to note, the operating cash flow was particularly strong in the last quarter, coming in at 2.5 million. Given the nature of the sector we're in and some supply chain challenges, a build up in working capital that sort of preceded the last quarter of the year, and we'd spoken about this on many occasions, it was pleasing to see that unwind. Inventory balance come down, trade debtors come down as well. So we look forward to that revision back to cash from TWC over the next couple of quarters. The graph on the right-hand side gives a bit of a sense of the significance of the step up in operating cash flow. We would expect with the outlook that we have that profile will be fairly constant going forward. If we think about what we have delivered for FY23, notwithstanding we're still on the audit process, I think it's pretty clear that the core Beam business has performed really well. Core Beam business represents the historical docks handsets that the business has been built on for over 20 years. Satphone Shop sales continue to be strong. Satphone Shop represents our retail distribution capability in a physical sense and also online in the ANZ market. Continues to be strong, and that's really benefiting from strength in the underlying markets, leisure, grey nomads, line workers, etc. The Zoleo business has continued to perform and Zoleo sales have been strong. We've seen that in the subscription numbers and the royalty payment flowing through to being 18% or more, up annualised at just under $1 million. We continue to see growth in that space. And then lastly, the expansion of the general subscription revenue profile of the business we continue to enjoy, and that's a big focus of the business as we go forward. Obviously, the margins in that space are higher. We have a footprint to distribute the product that gives rise to subscription revenue out of Satphone Shop and some of our other channels to market. So we look to invest further in securing more profitable, stickier subscription revenue. That's a real plan for the management team going forward. And I know we've made some recent announcements in terms of deals with Telstra and the like that have provided some good evidence that we're making inroads in that space. Zoleo is an important part of the portfolio for us. So we make money out of Zoleo and the Zoleo joint venture really in three ways. We make money out of the manufacturing sale of devices to the joint venture. We make money out of the subscription revenue from sales from subscribers of devices sold in our markets. And we make a gross margin on the sale of devices in our markets. Zoleo continues to deliver for us. The joint venture as a standalone entity is not yet profitable. However, if we look at the consolidated position, the Zoleo asset has delivered significantly for us and is a big growth driver for the company going forward with good margins. If you look at the subscriber numbers, the bottom right-hand graph, clearly the subscriber numbers in our markets have grown strongly and have grown strongly recently, really reflecting the underlying strength in the core markets that we serve. Continue to look to expand the product into more government and enterprise customers, and there's been recent product enhancements that are making that sales conversion easier and those conversations with sophisticated customers more easily obtained and deeper conversations. So this is things like dot on a map, etc. These are all long lead time sales, and to date, whilst there's plenty of trials, we're looking to continue to convert those trials into meaningful subscriber numbers. Again, they're sophisticated customers, long lead times. They need devices that can be ingested into their systems, and that's all stuff that we're working on. Many of them require personalised APIs, working with some of those customers on how best to optimise that interface. So Zolio continues to be important. Subscriber numbers have been good. We don't see any change in that space.
Thanks, Dean. Yeah, an important point, I guess, that the market that we're operating in, and for any of you who are aware of, the Iridium results that were posted just recently. I mean, Iridium continues to perform extremely well as being one of the most reliable and, extensive satellite network operating and fully licensed globally. So, the market itself, as you can see there, we're looking about a 7% CAGR to 2030 being just over $9 billion. Iridium's IoT space, which is where Beam operates in, is one of the fastest growing parts of the Iridium business. And revenue from that business jumped 13% year on year, with an increase of about $34 million. The increase in subscribers was 19% year on year. So you can see from the subscriber growth that we're seeing here, we're actually well ahead of what Iridium's averages are in their increases on subscriber numbers. So obviously, we're an important part of Iridium's business. It is nice to see that we're, showing signs of growth in the business beyond what Iridium is averaging. A lot of talk about high-profile competitors entering the market, whether it be Amazon, whether it's Starlink, or whether it's other new services coming to play. There is no doubt that there is increased competition, but as I've said previously, the new competition coming to market, increases the awareness of satellite communications products. People are talking about how satellite communications work, how accessible they are. We saw the implementation of satellite connectivity come to market on the iPhone, September of last year in North America, later in the year in Europe, and earlier on in the year, it was launched obviously in Australia and New Zealand as well. As expected, we knew that would, obviously be some awareness and some noise in the marketplace. We're quite confident from the enterprise and consumer channels that we deal with that this isn't having an impact on Zolio sales or other satellite communications devices, quite limited in the way that they operate. The expansive network that Iridium has that we piggyback on obviously means that, our devices work anywhere on Earth. Iridium's been around for over 20 years. It's a proven and tried technology, and the price points are still quite competitive. And there's a lot of limitations in some of these new services, whether it be across the iPhone or other new personal communications devices, that from a mobility perspective, which is, really the market that we're in, we're not focused on the big dish or providing, broadband connectivity to homes or to vehicles. Iridium's sweet spot is all about complete mobility, high level of signal penetration, and obviously low cost for device and low cost for use. So we're quite comfortable with our 20 years of experience, that the product mix that we have in the marketplace, the positioning of our products within the distribution channels, our direct-to-consumer approach, which we do through eBay and Amazon for selected products, and also our Sat Phone Shop business that provides direct-to-market access to be buying and acquiring products, and also subscription services, is starting to be a big part of our business, particularly in Australia. And being Telstra's main provider for those services to their enterprise, government and consumer customers, provides us a really good entree to be able to selling not only the existing Iridium products, but also other products in that space. So, we're excited the fact that we're in a market that continues to grow. There is a lot of talk in the market about satellite communications, and we're very comfortable with our 20 years of experience and a solid relationship with Iridium over those 20 years, and our product mix. We're well poised to continue to grow. Looking at the product positioning in regards to that, we believe that across Zolio through to the Iridium Go that's just on 8 years old, and to the recently launched Iridium Go Exec, which Iridium launched earlier this year, we're seeing very good sales of that. As we've announced, that was an initial $12 million US contract meant to be drawing down for product over a 5-year period. As of the end of FY23, just 6 months into the launch of that, we've already delivered 40% of that $12 million of commitment. And we're anticipating, based on current projections, that 80% of that first $12 million order will actually be delivered and fulfilled by the end of this financial year, with further orders coming, anticipated to come into FY25 and beyond. So very much the same situation we saw with the first Iridium Go when that was launched into the marketplace. That was an initial 5,000 unit commitment from Iridium, and we've delivered just over 70,000 units in the last 7.5 years. So quite optimistic what we're seeing at the moment. Iridium is very excited about the Iridium Go Exec product, the market applications that has, and also the void that it's filling in the marketplace. So, providing IP connectivity in areas where the previous Iridium Go didn't enable you to use simple light apps on your smartphone or on your laptop. The Go Exec does give you the ability to use things like iMessage and WhatsApp, send some images, and do some text email at a very affordable price. So, ranging from the Zoleo from $345 through to the Go Exec at $2,500. Obviously, you can see there that, they're very specific markets. These products really don't compete with each other, and it depends on the application and the use case. And, whether someone's looking for emergency communications or someone's looking for reliability to almost have a portable office, basically anywhere they end up on Earth. Looking at where direct-to-device sits in, so, Iridium's been talking about direct-to-device, and I'm sure other providers, will be looking at direct-to-device as well. The iPhone is obviously the first to market, but obviously has its limitations, as I said. These iPhones are not industrial devices. They're not robust. They have limited battery lives. They have delicate screens, and they really are a last resort emergency communications because of the limitations of how they access the network and some of the difficulties you actually have in using an iPhone to get network access. So whilst we recognize that is a competitor in the marketplace, we're comfortable with our product positioning and how we compete against that, and having dedicated devices that really meet what specific customer needs are. And with our growth opportunities across enterprise and government applications, this is really a market where, a dedicated device is exactly what an enterprise or a government customer needs to ensure that that is the only thing the person carries with them. It's one simple press of a button and gives them the ability to be able to generate an SOS, keep in touch, get weather updates, or anything of that nature. The outlook is very good for us where we sit at the moment. So, FY23 was really an inflection point for us. Strong growth in the Zoleo business, both in device sales and recurring revenues. Obviously, very nice for us to see the growth in the subscriber numbers and the recurring revenues within the Australian New Zealand territory, which we benefit more highly from other parts of the world. Strong growth across North America in the numbers. Important for us to recognize that we do still benefit from everything that happens in North America at the joint venture level within Zoleo Inc. The launch of the Go Exec and the commitment we have from Iridium, the launch of Go Exec, and also keeping the current Iridium Go device that's been around for almost 8 years, and having secured orders from Iridium for the Go device is obviously reinforcing the way that product's being positioned in the marketplace. So, we're very excited at the opportunities we've seen in FY24, continuing to support the sort of numbers that we've seen in 23, the recurring revenues starting to become a greater mix of that. And obviously with the recurring revenues becoming a greater mix, obviously increases the profitability as well. So across the whole business, we're very comfortable with where we're sitting today and the outlook for FY24. I'll just finish off with a small video here, and then we'll open up to questions. Thanks, Mark.
Thanks, Michael. Thanks, Dean. We did have a couple of questions around the Zoleo business, so I think maybe we'll tackle those. As you say, you know, the regional saffron business has been a big part of Beam for a long time, so I think that's probably a bit more understood than the Zoleo business. But I don't know, maybe Dean, you want to tackle this one? You know, the value of the JV, kind of how is that reflected within the accounts of Beam, and you know, how should investors think about, you know, the value that's being generated and building with inside that JV, and how to think of that in terms of, you know, the overall value of the Beam Communications business?
Yeah, thanks, Mark. It's a stimulating question. The way I look at it, firstly, is from a statutory point of view. So the balance sheet has a balance for the unamortized R&D we spent on the asset. So that continues to be reflected in our balance sheet and amortized. We obviously do impairment testing over that. We've actually done that today, so I look forward to presenting that to the auditors later this week. Then there's the value that we have contributed to the joint venture. So the value that we've contributed to the joint venture is accounted for in accordance with AASB 128, investment in associates and joint ventures. That's disclosed in the financials. As a result of the EBITDA losses of the JV, that investment is carried at zero and will only come back to value once EBITDA profit is derived by the JV. Obviously, that doesn't reflect, you know, what the market may see as that asset is worth. And there's a whole range of different valuation metrics people can apply to the performance of the business to derive what the value of the asset is. What our share of that value is then a, you know, somewhat complicated question, depending upon how that value would come back to us in, you know, what we would refer to as a liquidity event. And there'll be, you know, plenty of analyst research on how you may value the cash flows in the sector.
Okay, great. And then we had a couple of questions come in from the audience, so I just want to try and tackle some of these. What are the typical size number of devices, subs of B2B enterprise Zoleo customers you're going after in ANZ? So maybe, Michael, one for you in terms of
Yeah, absolutely.
market. If we just take your region, let's forget about the road post side of the business for Zoleo for this one.
Yeah, most of the trials we've done today tend to be somewhere between 5 and 30, which, you know, isn't unusual for enterprise, you know, trials and applications. Some of those opportunities vary between 300 and 1,000 per customer, depending on the application. So, you know, some of these trials are spread across, you know, local councils, emergency service applications, utility workers, transport, and obviously in the farming and agriculture sector as well. Some of these are done direct, some of them are done through our partners. You know, we're also seeing a lot more, you know, small business applications coming through. We recently signed up Elders to be one of our partners for channel distribution. And, you know, just up in the Northern Territory in Queensland, where you have, you know, larger farm and rural properties or agriculture properties, opportunities there where, you know, there are a larger number of units than a consumer application. But in some of the enterprise applications, you know, some of those can be 300 units plus, once it's accepted as being a piece of technology that does provide, you know, worker safety, very easy means of communication, two-way messaging in the event of an emergency, and the ability to obviously be able to track and integrate those devices into existing systems. And that's really been the key for us, that, you know, since we launched the APIs, also launching Zoleo Track, which gives people the ability to see multiple Zoleo devices on one screenshot. That's really opened up further trials and helped support some of the trials we've done, so that enterprise and government applications can use Zoleo as a device with their existing systems, rather than purely relying on, say, the Zoleo app to be able to locate and monitor where workers are in the event of an emergency, or just for general business communication.
Okay. Got a couple of questions around CapEx, Dean. You know, it's a 1 million run rate in the last quarter. Can you maybe just talk through, give some context to that, and you know, what should people be thinking about in terms of CapEx in FY24? I'm guessing it should still be fairly substantial given the, you know, as Michael talked about, you know, the big Iridium contract still needs to be fulfilled in the first half of the next financial year at least.
Yeah, good question, Mark. I think part of the CapEx response is we don't undertake speculative CapEx. Most of the CapEx is in response to identified products that customers want, be that a network provider or someone else. So it's not a speculative CapEx setting for Beam. The recent years have shown us to be pretty heavy with CapEx as we've closed out Zoleo and now GoExec. I think as we go forward, that workload will reduce and the CapEx spend will come off. I suspect we'll be able to provide more guidance in terms of, you know, where we're heading with CapEx in terms of dollars when we release full year results in a couple of weeks. But, you know, my guidance today would be it's coming off from where it's been historically. We're EBITDA positive. We continue to be positive cash generative. So we can look for, you know, at a very high level, similar sort of settings than what we've talked about today in terms of FY23 with CapEx coming off.
Okay. And then a question just on Zoleo royalties to Beam for Q4 23 were lower than Q4 FY22. So a bit of a specific question, but Dean, is that just a timing issue, the way something fell in between the same quarter last year and the same quarter this year, or?
Yeah, there'll be a lot of things driving that. Those two data points. One will be timing, one will be mix. I'll have a look at that, and we might come back on that question. You know, obviously overall subscriber numbers are increased, so it'll be a function of timing and mix. I'm not sure which one would have driven it the most though.
Okay, and then maybe if we just talk about the JV more broadly, Michael. You know, obviously, you know, Roadpost, for anybody who doesn't know, you know, is a major kind of player in the US market, and the bulk of the subscribers, as you've disclosed, are coming from their side of the JV, just given the market opportunity versus the Australian New Zealand market. Maybe just talk about, you know, that partnership, and you know, it's 50-50, but the subscriber numbers are, you know, a bit imbalanced at this stage. I know, correct me if I'm wrong, I remember from previous presentation, but you guys have the rights to, it's kind of Asia and Europe, but that rollout just hasn't really taken full shape yet. You've focused on the Australian, New Zealand market.
Correct. So yeah, as you say, the joint venture is a 50-50. We do get a lot of questions about this. You know, when Zoleo was in its incubation stage and the joint venture was developed, you know, we were both bringing market experience, systems, products to the table. So, you know, the joint venture obviously made a lot of good sense from a perspective of market penetration that Roadpost had previously had in Canada and a small part in the United States. We obviously understood the Australian market and obviously knew how to, you know, build and develop product. And, you know, the joint venture made sense for us to do the products, and Roadpost supported and provided a lot of the back end development for the systems. So, you know, we obviously don't see the numbers in Australia and New Zealand that Roadpost is seeing based on the population in North America. You know, we do benefit though. I mean, you know, Zoleo Inc., which we benefit from those customers. You know, we've previously disclosed that, you know, 30% of the profits from all customers in those regions go back into Zoleo Inc. So obviously we own half of that. It helps fund the Zoleo business. Obviously, as the Australian, New Zealand numbers continue to grow, and we do look to expand, you know, into other markets, we get more upside benefit from that. But, you know, I think it's important to recognise that, you know, the overall value in the 71,000 plus customers that live in Zolio Inc. aren't, they're still owned by Zolio Inc. So, whilst RoadPost generates those customers, Zolio Inc. owns the customer relationship, builds that customer, and controls, the brand and the presence in the marketplace. So, important for us to understand, that balance, and also just to recognize that, at the end of the day, there's, 30 odd million people across Australia and New Zealand, and, verging on 400 million people in North America. So, it's relative, but we also do, we both benefit from the relationship.
And as you say, at the point in time when it started, there was a good reason for the 50-50, given the skills and opportunities that both partners were bringing. Gentlemen, unfortunately, we didn't get to all the questions. We've just kind of ran out of time, and I do want to be respectful of your time and indeed for our next presenter who is standing by. So, Dean, Michael, thanks very much for coming back and giving us an update on all things Beam. And yeah, hopefully we can get you back in maybe a little later in 2023.
Absolutely. Thanks a lot, Mark.
Thank you, Mark.
Bye.
And we're going to go out west now to Perth, where we've got Mark Waller standing by. Should be a familiar face and a familiar name to microcap investors. Some of you might remember Mark from his time as CFO of Empire, which was listed not too many moons ago, but a while ago now, eventually taken over by Capgemini. But he's here to discuss recent IPO. Can I say recent, Mark? One click.
Yeah, fairly recent. It was back in September last year. So within the last 12 months, it's recent.
That's recent.
Yeah. Excellent. Thanks, Mark. Thanks for the introduction. I'll just share my screen. I've got a presentation here.
Coming through now, Mark. Yeah, it's coming up now.
Excellent. How's that, Mark?
Right now, Mark, so you can take it away, mate.
Fantastic. All right. Well, thanks very much for having me on, Mark. And yeah, look, as Mark alluded to there, previously CFO of Empire. We actually listed Empire back in 2007 just going into the GFC, which was an interesting time to list a company, but we successfully navigated that and more in the meantime. I'll just flick to this going. Okay. Disclaimer there, you can feel free to read that or take a screenshot and read it later. So jumping into One Click Group, as Mark said, we listed back in September last year. We at the time were trying to actually list back in July, leading into the tax season. I'll explain why that's important to us shortly. But on the board, we have Russell Baskerville as the non-executive chairman, myself as managing director. Russell and I both worked at Empire from 2005. Both joined as managing director and CFO at a time when the company had 20 staff and about $2 million turnover, listed in 2007, divested some assets, and I left about 6 years ago with 1,000 staff and 160 million turnover. And the business was sold 2 years ago to Capgemini for nearly $250 million, as Mark mentioned previously. When I left Empire, I met Nathan Kerr, who's also on the board. Nathan had an idea about creating a tax product and connecting it directly in with the ATO and allow people to do straight through tax returns straight to the ATO. And my first job out of university back in the late 90s was actually processing small individual tax returns on DOS-based software back then. And we had a couple of conversations and spoke about how we'd actually get that idea up and running and fund that idea and the broader concept of what we could do with the business. We got pretty excited about it. And on the back of that, we set up One Click Group and developed the One Click Life platform. We listed last year, as I mentioned, the shell that we listed into. Winton Wilsey was the chairman of that business, and that's how Winton came onto the board. Excellent corporate governance, strategy, and financial skills from Winton. We have 686 million shares on issue with an 11 mil market cap at the moment. Hopefully that'll improve as time goes on. But essentially, the company has two platforms. So our One-Click Life platform is a consumer fintech platform. We have 100,000 users on that platform at the moment. We provide tax returns and mortgages. And effectively, what we want to be able to do with that platform is basically allow people to manage all their financial lives in one spot in a simple, low-cost format from their mobile phone. So the key for us with that particular product is keeping things very simple, allowing everyday Australians to be able to use the platform in a really simple manner to manage all their finances in one place. One-Click Verify was actually born out of the One-Click Life platform. Within One-Click Life, we needed to digitally identify our customers, and One-Click Verify is basically the platform that allows people to do that. So we're a gateway services provider connected into the Department of Home Affairs ID Match, and we've basically pulled that into its own platform and are now commercialising that. We're right at the start of the journey of commercialising that particular product, but we have had some pretty good early wins, which is excellent. So just from a financial perspective, where the company is at the moment, we're seeing some really strong growth. 9 months, 10 months now after we listed, we've just been through our first 10 months of being funded with a marketing campaign, which has really excited and generated some huge growth. So we've grown user numbers from 65,000 at the end of December. And I should also mention we were sub 40,000 at the time of actually listing as well, and now grown to over 100,000 users on the platform. That's happened through a multi-channel marketing campaign, mainly focused on digital marketing and a few awareness campaigns outside of that. But I'll go into that in a little bit more depth in a minute. In calendar year 23, we've already surpassed the entire calendar year 22 revenue of 1.6 million. So we've still got that's as of the 12th of July. We've still got 5.5 months there of growth to really show what we can achieve in a 12-month period, being the first 12 months really that we've been listed. We've, as I mentioned, over 100,000 users. When we listed, we had a tax product, and that was literally the only product that we had generating revenue. We now, on the One-Click Life platform, also have a mortgages product. We allow next day refunds as part of our tax product. And as I mentioned before, the One-Click Verify platform that we spun out of One-Click Life. So we're pretty excited about the growth journey at the moment and seeing some really good results coming through from the marketing campaigns and business itself. So I'll jump through One-Click Life first to give you an update on what One-Click Life is, what it does, and what we're trying to achieve with it. And then I'll go through One-Click Verify and wrap up with a little bit about the business and how we operate and why I think we'll be successful. So I mentioned the 100,000 users, obviously. I'm pretty excited about that. So you'll probably hear me say that a few times in this presentation. But look, essentially what we do, right, is the One-Click Life platform is connected directly into the ATO. So when people come to us with a need to do a tax return, the first thing they do is sign up. We then identify or digitally verify the person's identity. That then connects into the ATO, and that draws back a significant amount of information about that user. That pre-populates a tax return, so it allows for really easy and simple lodgement of a tax return. The whole process of lodging a tax return can take as little as 2 minutes to 5 minutes. If it's a really complicated return, we're not really interested. We're just doing really the simple stuff, really basic. You know, we're not doing a whole heap of trusts and that sort of stuff. It's really just focused on individuals for this particular product. So we generate a lot of information about that customer, and what that allows us to do is surface and provide additional financial products to that customer then through the journey, right? So for us, acquiring a customer or acquiring a user on the platform, a really simple, nice experience completing a tax return, build our brand equity, and then surface additional products to the customer, such as one-click mortgages and down the track, additional financial services products. So that's basically the aim of what we're trying to achieve. Now, across all of our users, the whole of the 65,000 users that we had on the platform last year, we were able to generate $25 average revenue per user. That's an important number because that's something that we're certainly looking to target as we expand our product offering on the One Click Life platform. Now, our user numbers. So how are we actually growing our user numbers, right? So the key for us and the key age bracket that we're trying to target really is the 25 to 35-year-olds. Now, for us, that's people that have got one job or potentially multiple jobs. They've got potentially multiple super funds, some lost super or unclaimed super. They've either looking to purchase their first home, or they've got an existing home and want to remortgage or check if they can save any money remortgaging. They're going through that life cycle of potentially getting married, having children, requiring a will or an update to their will, et cetera, right? So they're the sort of people that are perfect with our platform. Our average income of people that are on the platform is around the $40,000 to $80,000 mark. So really in that middle Australia, as I said, we're not trying to target the wealthy end of Australia. It is that middle Australia. Although that said, we still have surgeons on there that earn $500,000 a year, CEOs of companies, et cetera, et cetera. So it really does appeal to everyone. And how we're acquiring those customers and generating that growth is through digital marketing means, right? So we have a number of acquisition campaigns running on Google, Facebook, Instagram, Microsoft, LinkedIn at any point in time. And we wrap around that awareness campaigns through YouTube. And we've just started to dip our toe into a little bit of TV as well. So our TV campaigns were quite successful through regional Australia. We've trialled Brisbane as a city to see what sort of penetration or additional penetration into Brisbane we get at times when ads run over in Brizzy. And we've also used Warwick Kappa in the adverts this year for our AFL campaigns as well, which you may or may not have seen depending on where you live. So what essentially One Click Life will become is a hub for everyone to manage all their financial affairs in one spot, right? So at the moment, we have our tax and accounting services, which includes simple tax returns and the ability to request a next day refund. We have a lending solution in there, which is One Click Mortgages. And within that, we act as a mortgage broker. So as I mentioned before, we gather a lot of data when we connect into the ATO and complete someone's tax return. What we've been able to do is simplify a mortgage application and allow people to go through about 8 different questions in relation to their financial situation and their mortgage. We then marry that up with all the information that comes in from their tax return. So that what it does is it really saves people having to complete, as you may remember from the last time you applied for a mortgage, it's about a 4 growing to 5, 6, 7, 8, 9, 10-page form at the moment with a whole heap of information that you then need to provide behind that. So what we're really trying to do is simplify that process of changing mortgages or taking out a mortgage. So as acting as a mortgage broker, what we see in terms of revenue is an upfront fee and then a 0.15 per annum ongoing fee thereafter, right? Now for us, we're acquiring customers at about a cost of $50, or a user, sorry. We're acquiring users at about a $50 per cost of that user. We charge $99 for a tax return per annum. So if we can increase someone or push someone into sideways into another product like mortgages, where we might get a $3,000 to $3,500 upfront fee, plus another $800 to $900 a year ongoing thereafter, we're significantly improving the lifetime value of that customer and obviously the average revenue per user that we're generating out of the platform. So a pretty important one and quite a quite good, obviously, revenue metrics around that. We also want to bring in down the track Visa cards and then a whole heap of other lending services as we mature around personal loans and car finance as well. We don't want to be a wholesale lender. We do want to broker that finance. Our financial services arm, moving on to that, is something that's in construction at the moment. We currently provide private health insurance and wills through the system. which have been quite popular. What we want to bring in is a full suite of financial services akin to an online financial planner, essentially. So allow people all the tools to manage all their retirement wealth and all the risk around their retirement wealth through our platform in superannuation products, investment products, insurance products, and then obviously the wills product that we already have. So that's what we're trying to build out there. That's in construction at the moment in terms of how we will actually present that and how we'll build it out. But we're having some good success in terms of what we're building there at this point in time. Just want to touch on the target market, right, for our tax product. So a lot of our acquisition and most of our acquisition does come from the requirement for someone to do a tax return on an annual basis. We see our target market as approximately 11.5 million Australians, right? The average revenue we generated from our tax product is $25 last year, as I mentioned. That'll grow this year through add-ons and additional products, such as the next day refund product that I mentioned. But in terms of the actual competitive landscape for tax returns in Australia, there's two key competitors that we really come across, which is H&R Block and eTax. Now, H&R Block is a bricks and mortar accountant. They've been around for a long time, obviously. They turn over $100 million and have a reasonable profit margin thereafter, but they're pretty wedded to their business model. They do have an online product, but they don't push it particularly hard. eTax, on the other hand, was born out of the government eTax back in the early 2000s when the government transitioned to MyGov. And they've been able to build an excellent business of over $30 million revenue, making about 30% profit out of that revenue, and provide a reasonable service. We think with the value add that we have around our additional products and our direct linking into the ATO and how we surface information for our customers and guide them through a tax return, we have a better product. So we feel as though there's a good amount of market share we can get from both those companies, and then just the day-to-day bricks and mortar accountants dotted around the suburbs, the ITPs, and so on and so forth. What tax does give us is quite a lumpy revenue profile. So it's lumpy to the current quarter that we're in, so our July to September quarter, which is where we see most of our user acquisition on the platform. We want to smooth that out with both the lending and the financial services revenue streams as we build those out. So what we're seeing at the moment is a building ongoing stream of income coming from our mortgages product. And as we build out our financial services and we start charging a fee based on the amount of assets under management within that particular platform, we'll start to increase that annuity revenue coming from that as well. So we're quite, and when I say quite keen, we're very keen to build annuity revenue streams that really smooth out that cyclical nature of the tax product revenue. Jumping into the one-click verify platform, and Mark, I note that you've given me till 8:20 to present, but I'll probably go a couple of minutes after if that's okay. When we built out One Click Life, we had to digitally verify our customers. Now, particularly connected into the ATO directly, it was something the ATO audited quite heavily and auditors on an annual basis to ensure that obviously the security of our technology solutions are adequate. And coming out of that, what the ATO advises is we had quite a sophisticated onboarding process through our digital identity verification. In speaking to a number of people in financial services, there seemed to be a niche in the market or a requirement there that wasn't currently being serviced. So what we've done is taken our digital identity verification into its own platform with CRM functionality and really an AML program in a box as such, which is something we needed for One Click Life, as I mentioned. So we've been able to separate that into a separate platform. We've been able to generate quite a bit of interest out of that product at the moment, and a number of customers have signed up and commenced using it, and the number of transactions on that platform is growing on a month-to-month basis. So what it does, is it's a secure platform with a full audit trail that tracks all the digital identity verification of your client set. For financial services, that's obviously something extremely important. It verifies their identity and then provides an AML and PEPs and sanctions check based on, I think it's 360 databases around the world. And what we found is the customers that are using the product are getting flags, and some are getting red flags as well in terms of their client set, which they weren't aware of before. So for their AUSTRAC reporting, obviously very important to provide those AML checks and understand exactly who their customer is in the Know Your Customer legislation. So the drivers for long-term growth in this one-click verified platform. First thing is we're very lucky in the industry tailwinds. I guess not so lucky from an Australian public perspective, but the data breaches at Latitude, Optus, Medibank and others are providing a real tailwind for us in that it's very front of mind for people and a topic of conversation as well. I think people have become a lot more aware of their security and identity management requirements on the back of those things. So for us, it's adding value is all about getting transactions into that system, right? So we charge on a transaction basis, anywhere from $3 to $5 per transaction. And we're just looking to continue to build and build and build the number of transactions on there per month. So we have signed a number of enterprise customers at the moment. We've integrated the platform with Xplan so that it's capable of being used very simply for financial planning businesses and small financial services businesses. And as we grow, we're looking to expand out those integrations into other CRMs and continuing to acquire customers. At a certain point in time, ideally, this product has the ability to operate cross-border. So we've designed it around being able to take in IDs from outside of Australia as well, and to work anywhere in the world. So we have some technology that allows people to be able to check the ID off a mobile phone onto a passport, basically, which will allow that. As we do that, we move into new verticals outside of just the financial services. And, you know, I think this particular platform has huge growth potential. We're, as I mentioned at the start of the presentation, we're right at the start of that journey, but a very exciting journey for us. So look, a little bit just about who we are and how we operate as a business. We're quite a small business, so we only have 15 staff. We swell up to about 20 people with a couple of casuals during tax time to help with demand of customer questions. But aside that, look, what we're looking to do is really change and reshape the industry that we're working in, right? So financial services, I don't see anyone out there that's trying to do what we're doing in terms of bringing that, you know, simple, low-cost ability for people to manage all their financial lives from their mobile phone in one spot. So that's something we're quite passionate about changing, and bringing that to all Australians, right? It's very hard for people, particularly sort of low and middle income people, to work out how to go see a mortgage broker, an accountant, a financial planner, an insurance broker, and try and do all that particularly from regional areas, but really from anywhere at the moment. So interestingly, most of our user acquisition, the revenue we generate, isn't necessarily during office hours. It's early in the morning or it's late at night, when people actually have time to sit down on their couch and consider their own financial lives, and jump on their mobile phone and start actually managing them. So, you know, a couple of things in how we operate is, we always see that we can do it better, right? So that's in our own business. It's also in the industries we operate in, but yeah, every day and every week and every month, we just try and get 1% better and 1% better and 1% better all the time. And the cumulative and compounding effect of all those improvements is what's really driving a lot of the value in the business at the moment. We like to have fun doing working together and how we operate. And we don't bullshit each other, and we don't bullshit our customers either. And that's something that's really important in what we do, and important in the values that we have as a business. We're trying to keep this technology solution that we've got in more of a human form than a robot form. There is quite a bit of robo guidance and robo advice through the product, but we are trying to humanize that and keep it an easy, fun to use product as well. And we want to make an impact, right? We want to make an impact in Australia in terms of how we're presenting financial services in Australia. We each want to make an impact on the One Click Group in our business, and we want to make an impact socially as well. So I'll hand back over to you, Mark. I've tried to race through that and make sure I captured everything.
Yeah, no worries. We'll get in a few questions here. In terms of the health insurance, offering, is that going to kind of follow the similar model as the mortgage broking one, where you're gathering in customers on behalf of HCF, Medibank, Bupa, whoever it is, and you're just going to be getting a trail fee, or is it a once?
No, you're spot on there, Mark. So what we're doing really is we're gathering information and demand from our customer, and AIA is actually the provider of that insurance product. So once we get to a point, we hand that relationship over and AIA complete it, and we get a trail income out of that.
And then,
so in a similar way to the mortgages, as you mentioned.
And then can we just delve a bit into the revenue model on the next day refund, and just how that works, and does it generate more income for you rather than just doing a standard tax return? And is there a risk of giving the refund and then the ATO coming back and saying, no, you're not due $800, you're only due like $670? Maybe just talk around how it exactly works.
Yeah, sure, no worries. Yeah, so as I mentioned during the presentation, we charge $99 for a tax return. A next day refund tax return costs $207. So there's significantly more income for us. And the reason there's a difference there is we do an accountant review on each of the next day refund tax returns. So what that means is we have an accountant jump in, review that tax return, and also review a little bit about the tax history of that customer, and whether there's any child support or Centrelink income and those sort of things. So what we want to do is try not to pay those customers which we might see as a risk, where their refund might be garnished by child support, or alternatively where they've misstated some of their income or deductions or something like that. So we can be very certain of what the end result is, and that the ATO will finalise the tax return as we expect them to. So there is of course a risk of default on whenever you're advancing money. We manage that through that accounting process that I mentioned, so the account review process. We also pay the lesser of $1,000 as a next day refund, or 50% of the tax refund. So we try and balance a little bit of our risk across, not paying the whole refund out to our customers.
And then if we just switch gears a bit over to One Click Verify, the revenue model for that, is it going to be a pure SaaS play? People are paying a license fee for the platform, or will it be license fee plus a small clip the ticket charge on number of queries or number of customers that they have? Maybe just give us a sense of how that revenue model will look in
no worries.
24 months time.
Yeah, sure. So there is two models. So there is it is a SaaS-based piece of software. You can either pay an ongoing fee and a smaller transaction fee, or alternatively a higher transaction fee and just a transaction fee. So when I say a transaction fee, you mentioned the word inquiry. That's basically when we charge the transaction. So based on an inquiry of someone's identity, we'll then go through, and that'll trigger an event, and we'll charge a customer on that basis. So for us, like the key to value in that is just continue to build and build and build the amount of customers that we're contracting through that system, and then that'll build the amount of inquiries and transactions through the system.
Okay, perfect. Mark, I think we leave it there because we're just up on time, and I don't think we're going to have time to squeeze in another question. But yeah, thanks for coming back, or not coming. Well, you coming back. Thanks for coming.
Yeah.
Thanks for giving
Excellent. Thanks, Mark. Thanks for having me on.
lie of the land of one-click group. And yeah, when tax season settles down, maybe we can get you back in to give us an update on where things are at, because you've certainly got a good few different pieces of the business all happening simultaneously. So best of luck.
Excellent. Yeah, thanks, Mark. Cheers. We'll speak soon.
Thanks.
Bye.
And we now will switch over to our final company of this morning's set of 4. I'm delighted to welcome back Quickfee. We've got Jennifer and Simon here. Jennifer, head of the North American business. Simon, who is CFO of Quickfee. Simon, I think you were sharing the presentation. Is that correct?
That is correct. Yes, we can kick off.
I'll let you know when I can see it now. Yeah, it's just loading. And yeah, if you can just go to full screen mode or slideshow mode, just so we get the full screen effect of it. No.
Are we good?
No.
We still seeing it, you know, with the slides coming down the left-hand side. So we're not getting the full effect of it.
Is it in presentation mode, Simon?
Cheers.
Yes.
There we go.
There we go. That's much better. So you can take it away. I'm not sure who's leading off, Jennifer or Simon.
Yeah, sure. I'll kick it off. Thank you so much, Mark, for having us today. We're really excited to share with you some of what has been happening in the Quickfee business over the last little while. Lots going on, and we're going to jump right in. We're going to give you a bit of a speed tour through what we do and make sure that we leave room for some questions, but also want to provide you with some of the context around our focus areas in the business. For those of you that aren't familiar with what we do, Quickfee's been offering B2B payments and financing for professional service firms, namely accountants and lawyers. And essentially, we're in the business of helping professional service firms get paid faster. That's what we do. And we offer 2 different types of payment options. We have our Pay Now option, which is ACH or EFT and card. And then we have a pay over time option, which is our proprietary financing product. And we'll talk more about that as we go through the presentation. All of our payment options are offered through a secure online payment platform. So if you want to get an idea of what it looks like, if you're actually a firm that is transacting and using Quickfee for payments, this is one of our customers, Monk Wilson. And this showcases really the simplicity of what we're offering. This is actually Monk Wilson's website, and you can see that when you go to their website and you say you'd like to make a payment, you go to this page and it allows you to either pay with EFT or ACH, credit card, or financing. When you click on one of those 3 options, you go right through to the next page, which is our Quickfee payment portal. And this is as simple as it is. The client can pick whether they want a monthly payment plan of 3, 6, 9, or 12 months, or if they want to pay ACH or card. In the case of card, the client pays the surcharge fees. There's no charge to the firm. So firms love it, and clients like the flexibility of payments. We often get asked who our target customers are and where we're really focused in the market. And on the next slide, we'll cover just at a high level of where we play. We are very, very focused on professional services. There are a lot of different types of industries and businesses that are interested in our services, but we're very focused on professional services with a B2B focused customer base. Our primary verticals in both the US and the Australian market are accounting and legal, or solution providers that sell into or provide services to accounting and legal, like a CPA state society, for example. In the US, we have some secondary professional services verticals, architects, engineers, management consulting. However, 100% of our sales and marketing efforts go into our primary verticals. For our firms, our key requirements are that they are qualified or licensed, and that they have greater than 1 million in revenue for our primary verticals or 2 million for our secondary verticals. We often get asked what makes us unique in the market. What are our competitive advantages to other solutions that are out there? Number one is we have no credit checks for the firm clients. So we underwrite the firm, and as a default, all of their customers are approved. So when they go to get a loan with us, it's automatically approved because they're sold based on the fact that the firm already has credit with us. The credit card surcharges are paid by the firm clients. There's no cost to the firm, which is a huge savings. The pay over time financing option is at no charge to the firm. So the firm gets paid in full up front, and the client gets the flexibility of being able to pay their invoice over time. We integrate with major practice management solutions, and we'll get into that in just a few moments. And I think something that makes us different than what was out there, and I just heard the last speaker speaking to this as well, is we support accounts receivable beyond just technology. And so we really pride ourselves in having a great level of customer service. And sometimes it takes an extra call or it takes an extra nudge to get an accounts receivable invoice paid. And we're right there partnering with the firms, helping them get paid faster. So we work beyond technology. And I'm going to hand it over to Simon, and he's going to talk a little bit about how we make money.
Thanks, Jennifer. We really have three main revenue streams, two under the Pay Now banner and our financing product. So under Pay Now, ACH or EFT, we collect up to 0.5% of the ACH volume from firms in the US. There's no charge for EFT in Australia, you may imagine, although we do charge a monthly hosting fee for our Australian firms. It's shown at the last line on that table. For credit card, we receive approximately 0.14% of the card volume in the US from that 3% surcharge that's paid by clients. In Australia, while we recognise the 1.5% surcharge as revenue, the margin in Australia after Visa and MasterCard scheme costs is negligible, really. The highest margin product, though, is our financing product, and that generates about 25 times the Pay Now margin for each dollar processed. And that's because it's effectively an interest charge that's charged to the client. And we'll charge a client up to 12.95% as a flat fee on a 12-month loan, so a lower fee for shorter loan terms. And that works out to be, having APRs roughly in the low 20s in both Australia and the US. And the important thing to note about that financing product is it's very, very low credit risk, because even though the client is repaying Quickfee, the installments, if the client does default, then the firm has given us a guarantee that they will then make us whole on any unpaid principal. So you both need the client and the firm to default for us to incur any bad debt at all. And that's why our bad debts are running at about 0.1% of lending, on an average over, the past 5 years. It is a very, very secure product from that perspective. We also generate revenue from our homeowner services pay over time product built around the Gyms Group franchise in Australia. You may have heard of Gyms Mowing, etc. There are about 4,500 franchisees, and we make a small amount of money out of that business as well. So in terms of where we've come from, just put some charts together here to look at how we're continuing to grow. We're well and truly past the impact of COVID from 2 years ago. The top left chart here, we're showing rolling annual volume shown by quarter for the last 3 years for our US Pay Now product. And you can see the continual annual growth every quarter up to $1.2 billion processed in FY23. Over the top right, we have the same chart for our financing product. You can see in the past 12 months, as we've narrowed our focus just to the professional services market, the growth in the financing product has increased on an annualized basis every quarter since the beginning of 2022. And then bottom left, it's a similar financing chart for Australia. You can see the steady recovery over the past 8 quarters since the beginning of 2022. And the last quarter in FY24, as we'll talk about, was a record lending quarter in Australia. We recently released our full year results guidance for FY23, which shows group revenue up from 10.9 million in FY22 to between 14.5 and 15.5 million Australian dollars in FY23. and net profit after tax improving from a $13.5 million loss in FY22 to between $8 to $9 million loss in FY23. And that reflects obviously the revenue growth, but also the cost reductions is in the business that we've implemented as we track towards profitability. And I'll pass over to Jennifer, talk a bit about the US market that does present the biggest opportunity for growth for us.
Thanks, Simon. So I think as we shared a little bit earlier, and as I was going through some of my slides, we obviously have a very simple business model and it makes sense. But what's the size of the market opportunity and how much have we already been able to penetrate in the US market? This slide's a little bit of an eye chart, but I'm going to walk you through it because it really does a great job of articulating what that opportunity is. In the US, our total serviceable addressable market is about 38 billion in revenue for accounting firms. This is just for the accounting market. This just doesn't even get into legal. Of that 38 billion, we have about 10 billion that are already doing business with us today. So we still have the remaining 28 billion that we can go after that are not our customers today. So we have a huge portion of the market. We're just getting started. However, another click down is even more exciting because of the 10 billion in annual revenue for firms that do business with us today, we're only capturing about 11% in our ACH and card payments. We're only capturing 11%. Why is this and how are firms getting paid? If you flip to the next slide, Simon, this starts to give you a little bit of an idea of the market dynamics. And the US is behind as it relates to digital transformation and adoption of e-invoicing. And as you'll see here, and we've actually just compared the US and the Canadian markets, 55% of US accounting firms are sending less than 50% of their invoices electronically. You can see the complete reverse in Australia, where they're almost all sending them electronically. So when you look at that piece of the pie and you see that we're getting 11% of their overall revenue through our payment platform, the rest is all coming through checks. And I call that out because there are people in other markets that are like, checks? We haven't seen checks in 10 years. But in the US, that's very common. And some firms, all they take is checks. And so we're behind on the digital transformation, but that means as the market itself matures and that digital transformation journey continues, we will pick up just through the actual market changes, we will pick up a bunch of that volume. I talked earlier about the practice management integrations that we have been focusing on. This has been a huge amount of our development time over the course of this calendar year. And in this year so far, we have released 4 different integrations with practice management solutions, which you can see here. And that represents a majority of the largest practice management solutions that are in the market. However, we have a number of other integrations that we're planning in this calendar year as well. And you'll see some of those noted below. So between all of these, it's rare that we run into a sales conversation or a firm, an accounting firm, that isn't using one of the practice management solutions you see on the screen. That integration saves them a great deal of time and helps automate a lot of the AR process and that bill to cash workflow in their firm. So it represents a huge time and cost savings. When we look at where our near-term priorities are for the US market, we actually have 3 pillars that are all of our near-term strategic priorities are falling under. First is around driving organic growth. We have essentially transformed our sales, marketing, and our new customer acquisition process over the last 9 months. And through that, you've seen some of the results that Simon shared a little bit earlier. We've set up a territory-based sales plan. We have new commission plans, and we're very targeted on the events that we know are important in the market to be able to help us continue our momentum. On the next part, it's around building and executing around strategic alliances. This is really important when you think about the growth that we have now, and when you think about having a sales team, I kind of consider that transactional growth. When you start to think about strategic alliances and partnership, that becomes about exponential growth because one partner can have you get in front of 1,000 firms as an example. So it's a real game changer. We've hired someone recently who spent their whole career in the area of strategic alliances for accounting partnerships. And so he hit the ground running and has already made a difference in the business. And the final part is around accelerating cost-effective product development and being really focused on where we do it. We've done a great job over the last 9 months of incorporating a lot of voice of the customer and what we're doing and making sure that the value that we deliver is something that's going to be impactful for our customers and the market that we don't have as customers yet, and our target customer base. We're going to continue developing our Connect integrations, but equally as important is around delivering an unparalleled firm experience and making sure that we have a best-in-class UI UX. When we looked at the integrations that I shared with you, Connect is actually kind of the hub that all of the integrations go through. And essentially what Connect does is it allows you to take the invoices that are created in that practice management solution and send them out digitally with a link to get paid right away. And so Connect is a really important part of our strategy because it helps drive greater penetration into the firm.
Thanks, Jennifer. I'll just cover a little bit about Australia. Australia is where the business was founded in 2009. Any of you who followed Quickfee in the past would probably remember Bruce Coombs, the founder, who IPO'd the business in 2019. He remains on our board, running the Australian business, doing what he loves best, going out and talking to accounting firms. We've currently got about 40% of the market in Australia, for the accounting and law fee funding market, with firms like KPMG, RSM, Piper Alderman. The business is profitable. However, we do see opportunities for growth, both organically in the accounting space as economic conditions continue to be challenging. We all know what's going to happen with home loans in Australia over the next few months. And that has a knock-on effect through small business into requirements for accounting law firms to not only manage their cash flow but provide lending solutions to their clients. But also through our legal disbursement funding business, there are opportunities there. That's probably the fastest growing part of our Australian business at the moment. And the Quickfee business in Australia is sustainable, and we expect its contribution to the group to continue to increase. I'll take you through some of the highlights from our recent Q4 update. It's released. It's very much a story of a strong quarter of growth across all products and positive momentum in both Australia and the US entering FY24. And particular highlights, record Q4 transaction volumes across all products in the US and Australia. It's all pay now and financing. Revenue for Q4 was up 23% to $4.3 million. And we had 50% revenue growth in both financing products in the US and Australia. And some of that's driven by increasing the rates we charge clients as our borrowing costs have increased with increased interest rates, but also volumes going up. The month of June, we had underlying cash EBITDA of negative 55,000, so very close to break even. And that demonstrates the significant progress we've made to track towards operating profitability, which is what we're aiming for FY24. Continued reduction in operating expenses in the quarter and across FY23. Importantly, as a leading indicator in the US, we signed up 120 CPA firms in FY23, and 49 of those had signed up for the financing product. And that firm sign-ups is a useful lead indicator of both improving transaction volumes and revenue yields to come into FY24. So it's very much a story of ending 23 pretty strong and starting FY24 strong as well. I'll hand over to Jennifer just to give a quick wrap up on our strategic priorities and outlook.
Thank you. So at a high level, Simon spoke to one of our strategic priorities being reaching profitability, and that continues to be our number one goal, and being very smart about not only where we spend our money, but also where we spend our time, and making sure that we're very focused on what's going to make the greatest impact on the business. The second key strategic priority is really around leveraging our most valuable assets, and that's our firms, our customers. And we have a lot of new opportunity to go out into the market and present some of our new solutions like Connect and our integrations, as well as better position our finance product. And firms are taking to that really well. So continuing to look for those new opportunities while continuing to build and execute strategic partnerships. And then finally, just making sure that we continue to enhance our systems redundancy and make sure that we've got business continuity into our services. Of course, we've always done that, but that is paramount and important for us. We want to make sure that we always are able to meet the needs of our customers. And we've learned over the last year that there can be little changes in the market that need to be addressed really quickly. And so making sure that we have full redundancy is important for us. And finally, before we wrap up and get into questions, we have really strong momentum heading into FY24. We've had, we've come out of great quarters and great years in both the US and Australia. We've got some economic tailwinds, and we talked a little bit about even some of the tailwinds just in the US market as well. We have a strong finish to FY23, which we've shared, and it's given us a lot of confidence, and actually July's been great as well. So we continue to see that push through into the new fiscal year. We have a steady reduction on our cash burn, and that is something that's continued from FY23, but that march to profitability continues. And then making sure that we're tracking towards operating profitability within our existing cash and borrowing facilities. So all of these things are items that Simon, myself, and the rest of the leaders in the business, as well as the board, are tracking on a day-to-day basis. But we're really excited. I'm energized by the opportunity. We've been able to attract some great talent into the business because they see that we have something that's very unique in the market and different than what anyone else is offering. And I think that the world is our oyster, and we're just getting going. And with that, I'll hand it back over to Mark for questions.
Thanks, Jennifer. Thanks, Simon. Simon, maybe one for you to kick off. I just want to talk about the financing product, and obviously, as you alluded to, we've seen a big jump up in rates both in Australia and in the US. I mean, globally over the last 12 months. And I know you touched on you've raised rates, but in raising rates, have you been able to maintain that net interest margin? And then a kind of a follow-on question from that is, as the book gets bigger, do different financing options, whether that's warehousing or club facilities with banks, come into play and have scope to be getting better deals because you've got a much larger book and it starts to become much more attractive to lenders?
That's a good question. I think in terms of sort of rising interest rate environment, not only is our current net interest margin pretty strong, we're currently paying about 10.5% on our borrowing facilities, and the APRs, as you saw, was low 20s, so that margin will continue. And the way the product works, if you raise rates or the fixed interest charge by 1%, it'll have a 2 to 3% APR impact. So we don't raise rates every month. Central banks do. We've probably done it twice in the past 9 to 12 months in each country. But in terms of demand, you don't really see a decline in demand for the product from clients if you do increase rates. And the reason for that is it's so simple for clients to take out a loan. The firms aren't paying, the clients are paying. There are no credit checks. It's literally, they go to the portal, they take out the payment plan to click the button. So it's very price inelastic as a product. So we are able to raise rates without any decline in demand or volume, which is interesting. And yes, as the book grows, we will look at additional opportunities and facilities to reduce that cost of funding for sure. The current book, the facility we have with Northleaf Capital Partners that funds, I think 90% of the accounting book is $40 million. So it's about 55, 53 Australian dollars, and we're not at anywhere near drawing to that full extent yet. But we will continue to look at alternative providers.
Jennifer, maybe one for you. When you're pitching to, if we just talk about the accounting segment that you walked through on the slide, and that 28 billion that's still up for grabs. Are you competing against other players in the market to get that, or is the biggest competitor in fact inertia from firms? This is the way we've always done it, and we don't kind of really see the benefit of offering this to our clients. It's not something they're coming to us kind of wanting or looking for. What's going to be, I guess, the main impediment to kind of capturing more that market that's currently untapped?
Yeah, that's a great question, Mark. I'd start by saying the status quo is definitely the lead competitor. And if we can get firms moving customers off of paying with check and moving to electronic payments, that is a huge advantage. There are, of course, we run into competitors in the market. There are others that are offering payment options like ACH and card, but that isn't what I would consider to be the crown jewel of our solution, which is our finance product. And there isn't anyone in the market that we come up against that's offering a like-for-like finance product. And so it's easy to overcome that. It's easier to overcome a competitor in the market than it is to get a firm that is behind on adoption of digital. That said, I mean, you go from talking to someone who takes 100% checks and they don't take any online payments to a firm that's wondering when they're going to need to start accepting cryptocurrency. So you see a really wide range of where firms are at in their digital adoption. And so it's we're kind of meeting everyone where they're at.
Okay. Simon, we've got a question on CapEx. Obviously, Jennifer mentioned it in one of her slides of the integrations with some of the partners and some to come in FY24, and not to mention upgrades to UI UX. How should we think about CapEx? As we look forward into FY24, should it model something similar to FY23, or has it kind of peaked in that last year?
Yes, I mean, as a reminder, we expense all our product development. There's a line in the P&L called product development, and that'll be, I think it was 5.2 in FY22. That'll come down to nearer 3.5, 4 in FY23, and then we'll probably see a similar reduction of anywhere from roughly about $500,000 in FY24. But we will need to continue to invest, particularly in the Connect product. Because Connect is how you basically drive a firm's clients to paying all their invoices through the portal. So the current 11 or 12% that we're capturing, Connect basically can move that to theoretically 100% of firms' invoices being paid through our portal. There will clearly be some checks in there, so you may not ever get to 100%, but Connect is what can drive that 11% to 100% in theory. So, we're continuing to accelerate that to integrate as many practice management systems into that Connect product as possible. But there will be some reduction next year.
Okay, but we've kind of seen the peak of it for now. Jennifer, just on the secondary verticals, you say you're not marketing to these, but you have picked them up. Is that through people changing jobs, finance staff moving from one industry to another? And is there a case we made to, given that you said it's a 2 million revenue business rather than a 1 million revenue business, is there a case we made for putting some marketing dollars behind attracting the architectural segment or an engineering segment or digital marketing segment at some point in FY24?
Yeah, that's another great question, Mark. But I think a lot of times, to answer your first question, when a engineering firm, an architectural firm finds us, it's usually one of two ways. Number one, they've been referred potentially by their accountant or their lawyer, and they've gone on to pay their own invoice. And they're like, wait a minute, this is a great way to pay. Could I offer this to my customers? And of course, they've already got a relationship with a client that we work with, and we want to be able to accommodate and work with them. So it's, that is certainly how we get most of them today, or they're finding us just online, but it's primarily through referrals. I think what we've learned over the last couple of years, we were trying for a few years to be too many things to too many people. And you saw, probably mentioned multiple times throughout our presentation, the word focus. And so it's really important for us at this point in time just to get really laser focused on accounting and legal, and all of our outbound efforts are focused there. When we have that nailed and that machine, like we've got everything running like clockwork and our customer service is just everything is humming along, then we'll say, okay, what makes sense for us to expand the business? Is it another market? Is it another industry? But at the moment, it's just this year, like my word is focus. And so we're just going to stay really focused on our core verticals.
And then can we just squeeze in one more question if we can? In terms of, a customer signing up to when they start contributing revenue. So if we, take on a decent sized accountancy practice to when they're actually contributing to revenue, is that, relatively quick, like a 1-2 month process, get the technology integrated into their practice management software in the back end, or is it something longer? So if we see, deals announced over the next 12 months, how should people think about that flowing into the accounts?
Sure. It's, I would say historically, when we signed up a new customer, we did not have a team of people that was focused on that time to value. And we have since changed that. So we have a team of relationship managers, and they're focused on making sure that we accelerate that time to value. Because it's not just time to value for us, it's for our firms to recognize this ability to get paid online and get paid faster. We know that typically, from when someone signs up to when we can have them live, it could be done in as short as 7 days. Is that what we're achieving every time right now? No, it's not. There's a lot of moving parts, and there's people in the firm that are involved, and if they have Connect, it's the integration, etc. But we know that 7 days is achievable. And so we have that group. I just had a meeting on it earlier today. We're watching those numbers and saying, how do we continue to tighten that up? Because we know if we can take what would normally naturally happen as it relates to penetration in a firm over 2 or 3 years, if we can shorten that down into 1 year or 6 months, that means a great deal from our transaction volume and our revenue. So accelerating time to value is a huge focus area for us.
Okay, great. Jennifer, Simon, unfortunately, we're going to have to leave it there. We're just over time. Thank you very much for coming in and giving us an update. Yeah, it's been a bit of a long time between drinks since Bruce was here, so it was good to get an update, and hopefully we can have you guys back in maybe the back end of this year or maybe early 2024.
Great. Thank you for having us, Mark. Appreciate it.
Thank you, Mark.
Thanks, Simon. And that wraps up this morning's session. Thank you to all our presenters, and we will leave it there. And I wish everybody a good rest of their Tuesday.